I'm Jeff Quartermaine, and I'm the CEO of Perseus Mining Limited, which is an Australian listed gold mining company. We operate on the African continent exclusively, where we currently have 3 operations, a 4th in construction, and some very prospective exploration ground.
Jeff, good to see you, sir. Welcome to London.
Thank you very much.
You doing the rounds?
Yes, indeed. We're talking to a very loyal group of shareholders, but also actually an expanding group of shareholders, because there is growing interest in the company given the success that we've had.
The company, the gold, the cash, it's exciting times indeed. You just put out a 5-year guidance. How's that been received?
Well, look, the guidance that we put out, I mean, it's an interesting situation. We're not obliged to do this, of course, as you know, but we felt it was necessary at this particular time to do that, because notwithstanding the excellent performance that the company's delivered over the last few years, we believe that in relative terms we're trading below some of our peers. And, you know, when we look closely at what the cause of that might be, we've identified 2 causes basically. One is the fact that we are on the African continent, isn't to everybody's taste, and so there is something of an African discount, so to speak. But perhaps more importantly, there was this misconception in the market that Perseus's asset portfolio contained a number of operations that had short lives, and that before too much longer our production profile would dip and all the rest of it. So what we wanted to do was to demonstrate to the market that far from that being the case, in fact we have a very strong future ahead of us, based on, you know, an excellent group of assets that are producing, you know, very well and at reasonable costs.
Right. So let's address some of those concerns then. Let's start with life of mine for a start. I mean, I think a lot of CEOs come on and say, well, it's always been a short life of mine. Here we are 10 years later.
Yes, indeed. Well, I mean, I was asked that very question last night on the call, and you know, the fact is that Edikan, for instance, started in 2011 with a 9-year life on it. We've now just extended that life to 2031. Similarly, Sissingué started life in 2018 with 4.5-year life. It's going to 2031 as well. So the ability that we have to be able to eke out more from what we've got, find additional mineralisation adjacent to existing infrastructure, etc., is something that we've done quite well over time, and I believe that we'll continue to do that. And another very good example of that is at Yaouré, where we bought the Yaouré mine with about 9 years of life ahead of it, based on 2 pits. Well, now we're just about to start work on the CMA underground that will extend the life of that operation for quite a lot of years to come.
Right, now you're obviously churning out the cash. Gold price is doing a lot for you. You've obviously got to keep your jobs to kind of keep the costs down and make sure that margin is as wide as possible. So maybe talk about the cost of mining these days. I think there seems to be a sort of new reality in terms of the cost expectations.
Well, I think broadly speaking, if you look at the industry, there has been an increase in costs over time. Now, quite what's driving that is another matter altogether. I mean, one of the things that people have been very concerned about is that with the elevated gold price, there's a temptation to drop your cut-off grade, which increases the unit cost of production, in order to pursue ounces of production. You know, size matters, so to speak. That's a particular perspective. It's not one that we share personally. What we do at Perseus is that the goal for us is to maximise cash production. Our focus is very much on cash production. So in looking at these extensions of the life of mine plans, as we've done in order to be able to and make the announcement last night, we've found a balance between size and cost and cash margin.
Right.
So what we've done in certain instances is that, yes, we have dropped the cut-off grade in order to chase the ounces, but we've also committed to the idea that we would hedge some of those ounces at current prices and lock in a very sizable margin, notwithstanding the fact that the unit cost has increased on those particular pits. At the same time, of course, we've also got other operations which are very low-cost operations in relative terms. And so when we've announced the 5-year plan, the average cost over that 5-year period across the portfolio is in the range of $1,400 to $1,500 per ounce. which in relative terms, relative to the industry, is actually a very acceptable number.
Okay, so what we're saying is here, we're not chasing numbers of answers, we're chasing economic answers to drive that which we're producing cash.
Correct.
That's number one on your priority. If I kind of look at the kind of universe of players out there, you talk about being undervalued and so forth, there's lots of comps that you're going to be compared to. Clearly, the production of answers is where people do tend to go for. If you give guidance within a range, the expectation is you've got to hit those. Do you think companies will need to start reporting on different things or emphasizing some of those factors differently? Like it is about cash production, not just.
Look, I think very much
You're
so.
judged the same, aren't you?
Yeah, no, very much so. I mean, the reality is, if you look back in time, and being as old as I am, you're forced to do that from time to time. But if you look at what occurred around the bull market in 2010 to 11. What a lot of people did do was at that time drop the cut-off grade, increase their cost chasing size because everyone said scale mattered. Yeah. And of course, when the gold price fell, which it inevitably did, a lot of people spent a lot of years making losses. And that is not very good for the stakeholders of the company. We look at our stakeholder group and say, well, it comprises host governments, communities, employees, suppliers of goods and services, and of course our shareholders, financiers. Now, for all of those stakeholders, other than shareholders, the benefit that they derive is from cash. If you don't generate cash, you can't create benefits. So cash is so important if you are going to operate, and that maintaining that social license in Africa is absolutely essential for you to be welcomed in communities.
Okay, good. Yeah, it does feel like there's a certain new paradigm at the moment in the space. But let me come back to something you just said. You're doing all this work to kind of keep costs down. You're working hard at it, and we'll get into some of the things that you are doing. You're not going chasing answers per se, and all to drive a kind of cash position which you control. Then you go and hedge it. So talk to me about risk management and approach to hedge, because it feels like, some people will go, gold's never going to come down. It's all good. Let's optimize this as best we can. What does history tell you?
Yeah, well, as history tells me, that's not the case. But what we try to do is to have our cake and eat it, as it were.
Yeah.
So what we have been doing of late, for the last year or so, and this is largely a function of the market, is using what's called zero-cost collars. So what we will do is buy a put option at, say, $2,600 an ounce, and we'll sell a call at a number that's higher than that. The cost of the put is offset by the revenue received from the call, and that means that you have downside protection, but at the same time upside exposure to a certain level.
Right.
Now, just recently we were selling call options at $4,600 an ounce.
Aussie.
US.
Which
means that there are people out there who believe that the gold price is going to be stronger for longer and that they'll make money off those calls. Now, from our perspective, if we've got the floor locked in at 2,600 and we get called at 4,600, our margin is very big. Yeah. And I'm not sure that we're overly concerned if that happens at that particular juncture.
Are there many people like that?
Well, I don't know, but there was enough to buy our call options. So that was an interesting thing, and it might have been a market anomaly, but because these things do happen. But then, by the same token, there are some very well-respected investment banks whose long-term price assessments are very, very high relative to what we've seen in the past, and they clearly have a view as to what the future holds. Maybe it's a statement as much as anything on the value of the US dollar, because these are US dollar denominated gold prices, but for whatever reason, that is the current level of thinking. But I do know that what goes up comes down. It's been going like that since Galileo, wasn't it, or something like that? But so the thing is that we would like to have a little bit of downside protection just in case it doesn't work out the way we all hope.
Right. Yeah. Because I noticed, like, since the beginning of the year, consensus used to be 3,200. It's now people are using 3,400. The banks are shifting in just 6 months. That's a meaningful change.
Well, it is really large. I mean, look, our long-term gold price incorporated into that plan that we published was 2,400, and that's well below clearly the market as it stands. But I think the consensus pricing was something like 2432 or something
That's
like
right.
that.
Two
Something
two
like
to
that.
432. Yeah, it's incredible.
Yeah.
To think of that in 18 months ago, I would.
Well, you wouldn't have, if you'd said that 18 months ago, people would have said you're mad, basically.
Yeah.
So, you know.
This is true. Okay, let's come back to the actual 5-year schedule, because I think you've had a number of banks obviously look at it. They've had time to digest it, and the feedback has been what to you? Do they understand it?
Well, it's been, yes, I believe they do. I mean, it's overwhelmingly clear, the positive, acceptance of it. And, I think people really appreciate as much as anything the transparency of what we're doing. We don't have any inhibition about saying this is what we're going to do, because at Perseus, we do what we say we're going to do, and those projections are underpinned by, 93% of the gold being produced on that 5-year plan is based on JORC-compliant reserves,
Right.
not on resources, not on imagined whatevers.
Yeah. Okay.
They're based on
Solid.
reserves. Yeah,
What about the other 7%?
it's on indicated resources,
Okay, so-
not inferred.
Yeah.
So and chances are that indicated resource will be converted to reserve in the next round of drilling.
Okay. So you did take a knock immediately to the share price. So obviously someone didn't want to hang around. So what was that about?
Well, look, I'm not absolutely certain, but it is a fact that Perseus was admitted to the ASX 100 index last Friday.
Right.
Now, that's a good and a bad thing, in a sense that it's good in the sense that a lot of the very large investors will invest in you because they're tracking the index and they need that exposure. But where there's a negative to it is that we do have quite a number of small cap funds invested in Perseus, and their mandate doesn't permit them to hold ASX 100 companies. So my suspicion, and I stress that this is a suspicion, is that one of those funds decided to use last night's announcement as a liquidity event and to get off the stock as they could. Looking at the trading pattern, the price fell almost immediately on opening and stayed pretty much flat for the rest of the day, up and down. So I think it was a one-off exercise. And had we actually been in a position where we could have traded using our buyback, we were in a blackout period.
Yeah.
We probably could have stopped that happening, but nevertheless, that's what happened.
Yeah, you kind of wish they'd talk more. It happens a lot. Okay, let's look at maybe what's happening on the ground operationally, because what you've laid out there is the fact that a lot of this is kind of based on, I guess, a de-risked environment for you. If you're at 93% on reserve and 7% on indicated, you're not factoring a lot of blue sky in there, whether it be from the exploration or M&A at the moment. Why take such a kind of cautious, conservative approach?
Well, I think what we're trying to do is to say to people, you can rely on what we're saying. Our track record is that we deliver on our promises, and this is a pretty hardcore promise. It doesn't mean to say there is not upside, because there is definitely upside in a lot of things there. And it also doesn't say that there's no risk. There's clearly risk, because a key element of that plan going forward is the development of the Enzaga project.
Yeah.
Now, while it's got out of the blocks very well and is going ahead full steam, I mean, we still have to complete construction and commission that project in order to be producing first gold in January 27. So that is a risk.
And pay for it.
I will pay for it. Less of a risk in the sense that we have significant sums of money on the balance sheet. I mean, we had $801 million at the end of March. The capital costs of the project's about $520 odd million. So, we can pay for that project from cash flow. And we are producing 1,300 to 1,400 ounces a day at a cost arguably of $1,200 an ounce at the moment. So in the current environment, our daily operating cash flow generation is quite material.
Right, and based on your 5-year forecast, I think the general consensus seems to be that you'll continue to accrue meaningful cash.
Well, it depends on the gold price, of course, but we are looking to recover something of the order of 2.5 million ounces over the next 5 years.
Yeah.
Now, if you say the all-in site cost is, say, $1,450, which is the middle of the range, well, if the gold price is $2,500, there's $1,000 per ounce.
Yeah.
Multiplied by 2.5 million, that's a fair bit of cash.
Yeah. Okay. Let's look at Enzaga, actually, because obviously you're viewed as a safe pair of hands when it comes to mine building. You've demonstrated that. What are the kind of concerns in country? Are we kind of fully permitted now? Is that?
It's fully permitted. Yeah. No, look, there's always risks around weather and things of that nature, and what have you. So we'll be mindful around that. But I think that Tanzania has a procurement policy that is very focused on maximising opportunities for local companies, and it is a little bit cumbersome in terms of getting through that process. So we could be delayed in getting through the process, for instance. So that's something that we're managing fairly carefully. In fact, what we are doing with our friends at Lycopodium, who will be doing the building of the plant, I mean, rather than doing an EPC contract, what we're doing is an E and a C contract, and we're managing the P ourselves because Perseus is already established in country. It already has all of its processes in place for local procurement and local employment, and so we can manage that process ourselves quite comfortably at a much lower cost than a contractor would do, because a contractor would do it very willingly, but they would put a margin on top of that.
And talking about the team, obviously you've had a CEO step down recently. How's that impact you?
Well, it hasn't impacted us at all, to be perfectly honest. I mean, one thing that we have done very well over time is build our bench strength, so to speak. So we've got a number of people in our organisation who are extremely capable people, and more likely than not, one of those people will step up and assume the guiding role in the operations place. And this is incredibly important, actually, because the thing that we need most is to have continuity of performance, continuity of culture, adherence to culture and things of that nature. So, by having people who are well versed in the way that Perseus does business, understands the nuances of the various countries that we're operating in, that's something that is extremely important to us. And so more likely than not, an internal candidate will be elevated in the organisation, and I would expect that they'll take over and it'll be seamless.
And what about at board level, where you've kind of you go from 2 producing lines to 3 producing lines and soon to 4 producing lines? How do you have to kind of beef things up, or is that just really kind of change in processes, which we've discussed now?
At a board level, when we have had change in the sense that we have a new chairman, Rick Mennell took over as the chair a year or so ago, and over time we will be replacing certain directors. We have a self-imposed limit of 10 years, so some directors will reach the 10-year slot and will be replaced. I mean, one of the things that we clearly need to do in terms of the board composition is look at the skills and contributions that different people can make, and try to have a coverage of all of the key areas in the business. So, the fact that you have people coming and going gives you the opportunity to boost areas perhaps that maybe not dealt with so strongly. And so, look, I think there will be change at board level, I've got no doubt, over a period of time. But, I can't see any reason why the quality of our board members would be diminished in any way.
Right. Okay. When you look out at the marketplace, and you've seen there's been a lot of transactions. Obviously, you're one of the people who's transacted recently. Not a lot of new answers coming in the market, which I wonder if that's good for the marketplace, and maybe guys like yourself should take a bit more risk.
Oh, well, absolutely. No risk about that at all. Sorry, it's a pun.
Yeah.
No, well, one of the things that we have absolutely committed to do in the new financial year is actually to embrace an organic growth, a greenfields exploration program. Now, we've said as a company, we're going to commit to this program. We understand that probably it's going to take 10 years from now until we may or may not be in a position to monetize a discovery. So, make a long-term commitment to it, resource it properly, and, do our best. Now, the thing is, we haven't been able to do that in the past because we haven't had access to capital, discretionary capital for it. But no, that's something that we're very, very definite on. And the reason why that is such a drive is that sort of business development process is the most efficient you can have in terms of, generating value for shareholders. You discover it, it's a whole lot less expensive than having to buy someone else's discovery. So that's a really important initiative that the company is embracing now as we speak. and hopefully we'll be successful in years to come.
Okay, now which also leads on to the question, which I'm sure you've had a lot during this trip and will continue to get, which is obviously your part ownership of Predictive. You've talked, and I think you said it possibly in last night's chat that you had, call I should say, is you want efficient allocation of capital, and you don't view that as necessarily the most efficient use of capital. Will there or could there be other types of ownership of other people's companies, whether through stock or asset level, where you do find more efficient? Will you look for maybe, I don't say greenfield, but maybe early stage development plays?
Yeah, look, we look right across the board. I mean, and if you look at the range, I mean, our sweet spot over the years has been projects that have been discovered and had some level of engineering applied to it, but we've been able to come in, deploy our engineering and development capability to create value. And you need look no further than what we did with Amara, and what we're doing with Predictive, et cetera, what we were hoping to do with Maya Sand. So that is what we would call our sweet spot, but there's very little opportunity out there for those assets, particularly in the current environment. The ones that do exist, I think they've seen some pretty serious price appreciation, which causes you to pause and reflect and say, well, all right, if I'm going to acquire this situation, I'm going to pay an acquisition cost, I'm going to pay a construction cost, chances are I'm going to pay a change of control tax in the country, and then the amount of money that you need to recover from after tax cash flow, given that all of the countries are starting to increase their fiscal take. Can I make a satisfactory return on my investment? And that's the question you have to ask yourself. Right now, where we are in the cycle, I think the acquisition of those properties is challenging from that perspective. So we look a little further afield and we say, well, look, are there production assets out there that under our stewardship might generate a different outcome to what they're doing today in the current ownership structure? And we've considered a few of these situations and we'll continue to. Now, one of the challenges there is that, and we've seen this before, is that if the company reaches the same conclusion ahead of us, chances are they'll run an auction to see who the highest bidder is. And historically we've never fared well in that auction situation. So for us, what we really need to do is to look carefully at the universe, try and spot opportunities, maybe engage in bilateral discussions ahead of a decision by the owner to go public tender the route, and see if we can't do something that way. So look, there's a lot of ways of skinning the cat, and there's a lot of opportunities, we believe, for actually growing the business in a judicious kind of a manner. And so if you look at, well, what are we doing with the cash? What's your capital management strategy? Well, there's three elements to it. One is capital has to be deployed to guarantee production. And that's what our plan issued last night is all about. The second thing is providing balance sheet resilience under a range of operating conditions. We don't know that the gold price won't collapse, and if it does, how are we going to fare? We need to be in a position where we can stay in business under all sorts of conditions. And then the third element is discretionary distribution of excess cash. And that's where we come into, do we invest in growth or do we return capital to our shareholders? And that's a balancing act. There's no exact answer on that, and that's something that each 6 months we look at the situation very carefully and say, well, how much cash do we have? How much do we need in the short term? How much do we need in the medium term? How much will we generate in the next period? What is likely to be surplus? And then how are we going to deploy that? And if it's capital returns to shareholders, how do the shareholders actually want to receive it? Do they want dividends, or do they want share buybacks? And so there's a lot of alternatives there. There's no 100% right answer. We do the best we can, and we revisit the subject on a regular basis.
Okay, yeah, absolutely. Okay, one last question, and it's around really, I guess, jurisdictional risk. You talked about earlier about having an Africa discount, right? And I sort of look at stories like read yesterday, the president-elect who's just got back into power in Ecuador. Not Africa, obviously, I know that, but it's Ecuador. What they've done is implemented some tax regime, or suggested tax regime, where explorers are going to be penalised in country in a way they weren't before, making it exploration is tough anyway because you're constantly raising equity and spending it, and raising equity and spending it. It's expensive enough. We've come off a period where ESG has kind of driven the cost of trying to do exploration business in various countries up. But the things like this, where you've got governments saying, "Well, look, we want a bigger piece of the pie. We want some of that money earlier." Jurisdictional risk across Africa, you might have a view on. Jurisdictional risk globally, you might have a view on. Mining's getting harder, it seems. And when you're trying to drive margin and cash business, managing all of this and having a view on all of this is important in terms of where you choose to do business. So if you don't mind talking to that.
Yeah, look, it's a complex issue. I mean, one of the simple fact of the matter, if we're talking Africa in particular, is the percentage of the population aged under 20 is growing almost exponentially. So host governments clearly are trying to feed, educate, employ their populations, and they believe that the way to do that is through increasing their revenue collection, i.e. tax. And mining companies are a pretty easy target, because once you've invested that money in the ground, you're not going to get up and walk away. So yes, there is if I look across the continent, it's almost like there's a convergence on fiscal regimes and the like, so everybody is upping the ante. But that is the reality. It's no good saying, "I don't like this and I won't have it." You will have it if you want to be in the business. And so what you need to do is to adjust your model in a sense that can accommodate some of these things, and find common ground with your host so that you can work together. And that's, that sounds all very airy-fairy, but that is fundamentally at the bottom of your decision making. Can I actually operate in this jurisdiction?
Yeah, but that's the kind of like one company working with a sovereign entity. And I think people look to jurisdictions where the sovereign entity, I'm going to include Canada in here, quite frankly, places like that where they're having
throw Australia in too, because they've done some pretty crazy things too.
Yeah, and they're back in power against it. How does that affect your thinking? And what does that do for competition? What does that do for the cost structure? What does it do for margin? These are big implications.
No, it is interesting. I mean, and it's different from commodity to commodity. I mean, if you're in a supply and demand commodity, you could say, well, look, if supply is going to diminish, demand's not going away, the price is going up, you're going to be okay. Gold's a bit different, of course, because it doesn't have the same supply demand dynamic, and prices reflect other sorts of things. So it's not as straightforward as it were. But look, for sure it impacts your decision making. I mean, one of the things that we've come to learn over time is that in going into jurisdictions that you're not familiar with, you really do need to do your homework and do it in a very, very thorough way, looking at things from a range of different perspectives, because not everybody has the same network. You might ask one person who speaks to this proportion of the population but doesn't speak to that proportion. And what you really need to do is to understand as much as you can and see how it all fits together. And then you've still got to make a judgment call. And that's what we're paid for doing, is for making judgment calls, using the best information we can and making the best decision. Now, if you think you're going to get it right every time, you probably...
You
just got one wrong.
That's a true story. Okay, well, look, you've got to get back on the road. You've got to keep telling this story. It's like I say, seems to be well received by the big boys, and it'd be interesting to see how the register evolves and changes, if at all, off the back of this news. But it'd be nice to see more companies reporting things this clearly going forward, because then it'll make it easier for people like me to do comps. But in the meantime, appreciate your time, Chef.
Thank you very much.
Good to see you.